Hello, I welcome all my viewers today to another video by reitspro.com. My name is Gaurav Jain. I am author of these two books here which are given on the screen here, and you can buy them online as well. You can always contact us on the email ID which is given here above. We start with the Why I Prefer series, and here we are going to pit REITs against various financial instruments and against say equity stocks, dividend stocks, mutual funds, debt instruments, and so on. And if you have not subscribed to our channel, please do that. And I'd like you to know that there is a WhatsApp group link in the description of the video, and there you can discuss REITs versus various other asset classes, and you can join the WhatsApp group chat also. So the first part of the Why I Prefer series pits REITs against equity stocks. So a lot of us are into equities also, and this is not a video to undermine equities by any chance, but why I prefer REITs. And for people who just love equities, please stay till the very end, because you could probably also fit in REITs with your own equity investing style and it could prove beneficial. For a REIT recap, you can probably just pause here and see what Indian REITs are about if you are not very familiar with that, or you can watch our earlier videos as well. So it's investing in REITs is generally done to build wealth, and that's what we all aim with all our investments, right? So but the problem with wealth is that Rome was not built in a day, and that's exactly what wealth building is about. So because it has to take some time, and when we look at equity returns, sometimes we feel that equity returns are the best, because if you see something like a Relaxo footwear, it's gone up from a lakh, an investment made of around a lakh rupees has gone up to 55 crores in a span of 23 years. That's a long time, but this is a fabulous return as well. And there are basically, when we talk about equity investing strategies, if we just talk about it as on a very broad basis and a general basis, everybody has their own style, but just as an understanding, equity investing strategy could be an active investing where you can actively choose, buy and sell and so on, churn the portfolio. And the second is passive, where you buy and hold. So you would typically buy and hold a basket of securities and hold them for a period of time. So the equity returns are great. In, for example, this Relaxo footwear case, you have more than 60% compounded annual growth rate, which is great. This is just fantastic. But the problem here is that if they are the best, could you spot it? So identification is a major problem. Secondly, when you gain some, you also lose some. So what happens to the total portfolio when you've lost some? What is the sum total? Secondly, could you always retain it? So what happens is, point number two, a lot of people, when they meet a certain target, they would tend to exit the investment. Secondly, and the third point here is that there are times the markets are very down, and that's when you feel you're bleeding, and can you retain it at that time? So the first part of identification and the second and third part of retaining it comes in as a crucial factor when you talk about identifying and picking equities. Next part is that individual stocks, there is also a danger. So there is a Sensex story there was a story in a newspaper earlier where it identified there were only 7 out of 30 stocks that were there in 92 which were still a part of the index in 2018. So after about 25-26 years, more than 27 stocks vanished from the Sensex. So you can't really hold on to stocks also for that fear also a lot of times. Right? Now you decide that active equity investing does not suit me, and I'm not going to do that because it requires too much time and effort and skills. So I'll go for passive equity investing, and let's take the case of index investing. You invest in index. So what you say is that, okay, I'm going to buy and hold. So it will automatically invest in a basket of securities to diversify. And then I'll generate equity returns over a long time frame, and that will be commensurate to the equity returns offered in the market. Now let's see what are the returns that the market has shown in the past few years. So if you look at 2022 versus the base price, which was 1996, the market has gone up 18 and a half times. So 1000 price has become 18,500. The year was 96, now it's 22. This is 26 years. So if you look at the returns, it is 11.9%. The simple formula is 1 plus 11.9% raised to the power of 26, which is 18.6. This is a check. 1000 into this figure gives you 18,600, which is very close to the assumption. So it's gone up 18 and a half times, but you have a CAGR of 11.9% from the markets. This is what your passive equity strategy will yield. So wealth building happens to be a game of patience for most, actually, except for the skilled and very few lucky people. And that's where REITs can help. REITs for long-term wealth building are excellent buy and hold assets. Of course, some people also like to do trading in that, but by and large, they are wealth builders. So a lot of pension funds and insurance companies globally love to buy and hold and give returns to the investors through REITs because they are steady wealth generators and they beat inflation. And REITs is basically about real estate. And so if you look at, this is the data here, real estate over the past 100 years, it has actually beaten stocks a little in terms of returns and in terms of volatility hugely. So this is the kind of returns that REITs will also generate, because REITs are after all real estate. So REITs are the real estate play which can help you in this waiting game. So how does it do it? So 3 points. So like real estate, they build wealth over a period of time. Both your incomes and your capital goes up. So it's more like passive because you buy and hold, and each of these real estate mutual funds is like real estate investment trust is like a mutual fund for realty assets. So each of these trusts has a portfolio of diversified assets. So REITs in Indian context for wealth building is going to give you 3 kind of benefits. According to me, it's one, return similar to index investing. That's so basically it should give a ballpark of at least 11.5, 12%. Then secondly, high payouts in the form of that's what forms most of this base returns. And third point, the point 2 ensures that there is less volatility because the payouts form a very huge percentage of the total returns that you get from REITs. So this is what let's explore that one by one. So the typical estimated return, you can see an earlier video where I've outlined that it's a 12 to 15% return, 7 to 8% in recurring, and 5 to 7% as capital gain. So how? Because right now if you see the yields would be about 6%, but it really gets amplified to 8% on a pre-tax basis. Please see earlier videos and this concept will get clarified more. So let's see it in practice how it happens. So number 1, returns very similar to index investing. If you see all the 3 REITs from the date of the IPO to an assumed date of 25th November, these are the prices on this column. So these are the prices on this column, and the percentage returns from the IPO to price is these. So the pre-tax returns are actually higher than the one shown here, and for that I have already mentioned, do see our earlier videos to understand that. If you look at the part 2, these absolute returns by way of payouts, the payouts are very high as a total percentage of the returns generated till date, and this can also be clarified in the table here. So if you see the same table, I've highlighted the relevant portions in yellow here. So 118 is the total nominal return, and out of this, distributions comprise these in this column, and this is about 70%. This is the total amount, and out of that, out of 118, say 78 is now out of this is total distributions. So a large part of this portion, 10%, 10.5%, comes out of this amount. So now what happens is that this second point ensures that you have less volatility to deal with. So because you never know whether you should enter here or exit here. So in a typical case of an instrument which gives you most of the returns by way of appreciation, you would really like to enter and exit at the right time. In this case, in the case of REITs, because such a lot of amount happens to be in terms of payouts, it really does not give these kind of fluctuations very big. You don't really get these kind of very big fluctuations over a period of time. Short periods you may do get that. Now this is also shown here. So if suppose the price actually reaches the NAV, that's the assumption. So 10.5% would become around 14.5%. So this is now this is the case here right now when the prices are very down. But if they were to reach the NAV, they would become higher. So the volatility is lesser over a period of time. This kind of difference even becomes lesser. So REITs are very similar to passive equity investing in terms of returns, and additionally they will give stable incomes, and they have less volatility in prices and helps tide out the bad times for markets. So in a sense you can actually retain REITs because you bleed less, because they are less volatile and appreciate over time, most probably because property appreciates in India. And also you have a medicine for that pain when you are bleeding, because you have very high payouts which are virtually tax free. Now you might still say that I'm an equity lover and I love normal equity stocks because of the phenomenal returns that they can offer which REITs cannot, which is to some extent very true. So now, can REITs be useful to me? Well, you would like your returns in equities to multiply, so that's where REIT fit in. Now a basket could be there to take care of your recurring needs and to quench your thirst in between, whereas you can leave your equity portfolio to multiply. And so has also been stated by a known investor that I have taken something for rental income to prepare for the marathon in the equity market. So that's what one can also combine REITs with. Now what are your views? Do connect with us on the WhatsApp group which has there is a description below in the description section, and you can also write to us in the comments, and do subscribe to our channel. Thank you so much. You can write to us at this ID also.